Welcome once again. Today I'll be continuing with the chapter Capital and Revenue Expenditure, chapter 6. So let's begin. We have already discussed about capital expenditure. Capital expenditure helps to generate economic benefit for more than an accounting period. Occurred irregularly once in a while, and it is of big amount, and it is financed from a long-term capital. So ultimate capital expenditure results into a fixed asset. It also increases the efficiency or the earning capacity of an existing asset. Next, capital expenditures. It includes fixed assets, means the capital expenditures from which a future economic benefit arises. Incidental expenses incurred till the assets is put to use. These expenditures are shown as assets in balance sheet. It is incurred for growth of the business and written off in PL account. So these are the later concepts, but for the time being you must know the meaning of capital expenditure, and you should be able to differentiate between capital. After completion of this chapter you should be able to differentiate between the capital and the revenue expenditures. Examples for your better understanding: purchase of a furniture, wages for the construction of a building, building a floor for an existing building, installation expenses of a machine, and legal fee to acquire a property. So these are the examples of a capital expenditure. Next, I move on to revenue expenditure. Businesses' recurring or regular expenditures are known as revenue expenditure. Benefit is for a single accounting period, necessary to smoothly run the business, and financed from a working capital. And it is shown in trading PL account as an expense. Two examples for your better understanding of revenue expenditures are payment of salaries, rent, purchases, annual whitewashing of for office, stationery purchases by a stationery dealer, and the bad debts, the unrecovered amount. Next slide is about the capital versus revenue expenditure. First, you can see nature of business, and for revenue expenditures, purpose of expenses. Next, recurring nature of expenditure. What is the interval of expenses? Effect on revenue generating capacity and materiality of amount involved. Next, I move on to capital receipts. These are the long-term receipts. They are irregular in nature, not the normal revenue business activities, creates long-term liabilities. Examples: issue of share capital and debentures, donation or loan received, insurance claim on account of machinery damaged, and entrance or life membership fee received by a club. Revenue receipts. Revenue receipts are short-term receipts. They are regular in nature, received in the normal course of business, and shown in trading PL account as in the income side. Some examples of revenue receipt: sale of goods, interest or commission earned, collection from debtors, and subsidy from government for working capital. Next, I move on to the deferred revenue expenditure. Revenue expenditure, but the benefit may extend over a number of years. That is deferred. It continues for a long period of time. Written off in a particular proportion over the years according to the benefits received. Miscellaneous expenditures, fictitious assets such as goodwill, non-current assets minus balance sheet. Examples of deferred revenue expenditure: heavy advertising expenditure for a new product, cost of experiments, discount on issue of debentures, and preliminary expenses. Is capital versus revenue profit. Profit earned normally or usually in the ordinary course of business is revenue profit, taken to PL account, credit side. Unusual profit earned can be regarded as a capital profit because it is once in a while and it is taken to capital reserve in the balance sheet. Capital reserve can be used to write off any capital loss. Reserve is the amount which you have kept for any uncertain situation which may or may not arise. It is to meet the uncertain expenses, uncertain benefits in future, and it is generally used to write off any capital loss. Example, profit earned on reissue of shares or assets sold above cost. So profit above cost minus capital profit till cost revenue profit. Next, let us move on some MCQs. First question is, insurance premium paid for risk against accidental loss of properties is an example of number A, revenue expenditure, number 2, capital receipts, number 3, deferred revenue expenditure, and capital expenditure. So can anyone guess the answer? Yes, the answer is revenue expenditure because it is an insurance premium paid. Next, question number 2, rupees 40,000 spent on repairs of newly purchased old machinery is debited to which account? Repair account, cash account, general expense account, and machinery account. Newly purchased old machinery. So can anyone guess the answer? Yes, the right answer is D, that is machinery account. Question number 3, which of the following is an item of expense? Charges paid for installation of machinery, recovery of electricity bills paid for employees, payment of electricity deposit, and payment of electricity bill. So the right answer is D, that is payment of electricity bill. Next, question number 4, purchase of packing material for distribution of goods from Calcutta Paper Mill Limited. So revenue expenditure, capital expenditure, deferred revenue expenditure, none of the above. So the right answer is A, that is revenue expenditure. So please go through the chapter and practice the numericals that are given in your textbook. So thank you and have a nice day ahead.